You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors, Mark Longo and Dan Passarelli.
Oh, it sounds so good to hear that music again. It's been too long, but now we're back in action. Yes, it's time for Options Bootcamp, the program here on the old Options Insider Radio Network, where we break down all the interesting options strategies and trades and tips and techniques and educational information that you, the basic stock guy, the basic retail stock trader looking perhaps to dip your toes into the options pool, or maybe you've gone into that pool a little bit and maybe you need a little bit of guidance on how to get to the deeper end of the pool. We got you covered here on the old Options Bootcamp program. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. Quite a few programs for you guys to sink your teeth into, including many great archive episodes of this fine program. I know it's been a little while. It's been a hiatus. People have been asking me, when are we going to do another Options Bootcamp? When are we going to do another Options Bootcamp? Well, we got you covered. We're hitting you up right now. And again, you can always check out the archives pretty much any place you find your favorite Options Insider programs. The easiest place, of course, theoptionsinsider.com. Just choose your program of choice from the right-hand side there of the homepage. Click on that link, and then the whole archives are available to you right there. You can just play them right there from the player or from the page. It's really easy to do. Of course, you can always go to iTunes, your TuneIns, your Stitchers, your so-ons, and your so-forths. So every platform pretty much of choice we're available out there. Also, we're doing this one live, so hopefully, I know it's kind of a spur-of-the-moment surprise on you guys, but if you do follow us on Mixlr or grab that link, you can always join us live whenever Dan and I and maybe some extra special guests sit down to do some options boot camping, then you can be the first to hear it, which is always fun. And however you listen, whether it's live, whether it's via the website, whether it's via iTunes or via our app or Donkey Cart in the Ukraine, however you get the program, we do love to hear from you guys. So hit us up with those questions, those comments. We do have quite a backlog today. As you can imagine, the show's been on hiatus for a little while, so we got quite a list of questions. We'll get to those in a little bit, but first let me introduce my cohort, my partner in crime, the evil yin to my yang, he of the black hat infamy, Mr. Dan Passarelli, the founder of Market Taker Mentoring and the author of many seminal options tomes, including Options Greeks and a bunch of other good stuff. He's the man of the Greeks over there. Mr. P, welcome back to the program, sir.
Well, hello, Mark. It is very, very good to be back. Really excited to talk about some options today.
All right, so you ready to do some basic training with our folks here?
Let's do it.
All right, let's do it. It's a little basic training on Delta.
All right, Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? Yes, sir. You're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Yes, sir. Pull in. Prepare to learn. Yes, sir.
All right, everybody. Like the man said, this is the portion of the show where we take some basic options concept or principle and proceed to break it down into its salient parts so you guys can really break them down and chew them over and digest them very easily. I thought today, since we're coming back to the show after a while, I thought we'd come back to a topic we haven't talked about in a while, but it's very important, and also perhaps take an interesting new spin on it as well. So if you're saying to yourself, well, I get Delta, I don't want to listen to that, we got you. Don't worry. Stay tuned. We'll get to an interesting little twist on it in a little bit. But let's start with Delta. Of course, I mentioned, Dan, you have written many seminal tomes on the Greeks, so this is right up your wheelhouse. But basically, obviously, Delta is usually the first of the so-called options Greeks that people usually come across in their options education. Usually the main Greeks are, of course, Delta, Gamma, Theta, Vega. And these days, with interest rates on the horizon, we are seeing Rho peeking its ugly head out every now and then, even though not really one of the kings of the Greeks, shall we say. So predominantly Delta, Gamma, Theta, and Vega. Those are kind of the big four most people really sink their teeth into. And for you guys, a lot of you coming from the stock world where you're used to trading things directionally, Delta is usually your point of entry to the options world. And of course, Delta being the rate of change of an options price with a unit movement in the underlying. So if you have a delta of 50 or 0.5 and the underlying moves $1, you get that delta, options price is going to change by 50 cents. It's just a basic rate of change variable. Pretty straightforward. There are some other permutations of it that get out there. Some people think of Delta. Obviously, it is a hedge ratio as well. If you're a professional, it tells you how many shares the underlying you have to trade if you want to do that trade. Delta neutral. That's a little bit more sophisticated for some of you out there. And then, of course, there's a bit of a misperception that Delta is also the probability of an option expiring in the money. It's maybe an approximation of that, but Delta itself is not the pure probability. So if you think of it in those terms, just kick that out of your head for now. It's not really the use case, even though that is still kind of part of the common parlance of ex-floor traders. You ask them, are you going to be somewhere? I'm about a 70 delta. So they still use it in those terms, even though it doesn't really mean that. We're going to focus here today on the directional bias, the directional use case for Delta, which is the most important part. Dan, before we go any farther, before we get into what really inspired this, which was an interesting newsletter you guys put out over there at Market Taker Mentoring about some of the interesting use cases of Delta. Before we get to that, obviously you've written literally the book on the Greeks. You've written multiple options books, but the Greeks have always been a focus for you. What are your thought process, and what do you emphasize with people when they're coming to you maybe over the MTM for the first time and you're teaching them about the Greeks, in particular Delta for the first time? What are some of your primary talking points on this Greek?
Yeah, I mean, Delta's basically your best friend as an option trader. It's clearly the most important Greek. And I mean, it stems from, of course, awareness. It stems from being aware of exactly what it is. And, you just kind of went through the definitions of that. The primary and most important, of course, being it's the directional sensitivity of an option relative to the price change in the underlying. Then, what's really important tactically and hands-on is the utility of that. What exactly we can use that for. And there's a whole bunch. One is, setting up trades, like especially breakout trades. Hey, if this stock breaks above this resistance level at $120 a share, that's where I want to buy. Well, wait a minute, what's the price of the option going to be then? Well, I can use Delta to figure that out. Or, getting out of trades as well. Hey, I'm long these calls, blah, blah, blah. Where do I set my target? Well, I want to set my target when it gets up to resistance, for example. Okay, well, what's the price of the call going to be if the stock rallies $3 and is trading at resistance? Well, okay, Delta can tell me that. So, I mean, that's really what my focus is not just the trivia of, oh, look, here's what Delta is. Isn't that interesting? Go talk about it at a cocktail party. It's here's what Delta is. Here's what we do with it. This is why it's so important.
Yeah, and there are a few rules of thumb you should probably keep in mind that help you maybe situate yourself when you're looking at an options chain for the first time, give you a sense of kind of where you are and how these options should at least perform. This is an approximate level, which is, of course, when you're looking at the money strike, which is where the underlying is actually trading. So in our proverbial world, everyone loves XYZ. Let's say XYZ is trading at 100. So the 100 strike is your at the money strike. The options on that strike, both the put and the call, are going to be in the 50 ballpark, a little more than 50, a little less than 50, but somewhere right around 50, depending on where the underlying is vacillating around. So going into the game that that's what you can expect around your at the money strike. So it gives you a little bit of a centering for where you are on the option strike chain. Now, as you go, out of the money options are going to be in the lower delta range, obviously. So somewhere from 50 to 0. You're never really going to see a 0 effectively, but you go somewhere around 1. But somewhere out of the money options are going to be somewhere between 50 and that 0 range. In the money options are going to be somewhere above 50 to 100 using the nomenclature. If you see decimalizations, 0.5 to 1 effectively. And that means as you get deeper in the money, of course, your delta is going to approach 100 or 1. It probably never will really get there. 99 is probably the highest you effectively will ever see. But that said, if you're deep in the money, that means effectively you have an option position that for all intents and purposes is really just the underlying from a delta perspective. The underlying moves a buck, that option is going to move a buck as well. So that gives you a little bit of frame of reference for as you're looking at a strike chain for the first time. An options chain could be for a new option, could be for something you've traded for a long time. Either way, those rules of thumb are pretty much always going to apply. So at least when you're looking at delta, how that's going to work. Then, of course, that could inform your trading. If you buy an at the money call on XYZ on that 100 strike and the underlying moves $1, you have 50 cents of worth of bang for your buck in that option. Your option is going to increase by 50 cents. Of course, delta is not a static number. It's going to change. That's gamma. That's another variable, which is another Greek, which is the rate of change of your delta. It's not the focus of this episode right now. Gamma is a whole other conversation in and of itself. But also be aware that as you're trading these options, that delta is not a static variable. It doesn't stay 50 throughout the entire life of that option. It's going to change depending on where the underlying is. The volatility and time decay are going to change that delta as well. So a lot of things can impact delta. It's worth noting that it's not a static variable. Coming in at the money is 50. In the money options, somewhere between 50 and 100. Out of the money options, somewhere below 50 to 0, somewhere in that range. That gives you at least a bit of a ballpark to work with. Dan, any other salient points, tips on delta here before we get into what actually inspired this segment, which was your newsletter?
Yeah, you touch on a lot of the real important points. I was just kind of thinking about it while you were talking. Actually, you talked so long, I just kind of spaced out. My mind started wandering.
I am known to do that on occasion. I do get paid to talk after all.
I'm half kidding. I was kind of thinking about it, and I think there's sometimes like a lot of novice traders, they think, oh well, I don't need to worry about all that stuff, but the fact is, you'd be surprised at just how often it is you need stuff. It's kind of like delta is the rate of change of the option, right? So it's kind of like, if you're driving somewhere and maybe it's like a little road trip or something, and the person you're meeting says, well, what time do you expect to be there? And if you don't know how fast you're driving, what the speed limit is, and how far you're going, well, you can't answer that question. But we're totally used to using real simple math like that in our everyday lives. Like, oh, well, let's see, it's 100 miles away. I'm driving 60 miles an hour. I'll be there, whenever. You can just simply use that math to figure out what time you'll be there. And you tell your friend, this is when I'm going to be there, but then options, when there's like money on the line, you're trading hard-earned money. Like, don't you want to be able to use those same really simple arithmetic skills to, set profit targets, set loss targets so that you can limit your losses and trade better, more effectively? So it's really just kind of the same thing, like, hey, if the stock is here, here's what my option is going to be worth. Okay, now I have very, very, A, realistic expectations, and B, really good, a really good tool for setting targets, which is, anybody who's had any longevity as a trader knows, you have to set profit and loss targets. Otherwise, you're just kind of winging it, and it's not going to work out in the long run,
I'm sorry, I didn't hear you. I fell asleep because your conversation was I'm kidding. It was scintillating. As always, sir. Speaking of scintillatings, that's what I get for doing a couple of things at once over here while I'm talking. But of course, the reason we started talking about Delta again was actually, it's your fault, Dan. I blame you. Because you guys put out an interesting newsletter every week. If you haven't subscribed to it, get on over to markettakermentoring.com and you can subscribe to the newsletter there. And they put out a lot of interesting things. And you guys detailed an interesting use case for Delta, that a real world one, which is always great for us and for our listeners, that you guys encountered over there in your mentoring, in your coaching classes. And the article was entitled, if you're looking for it, listeners, Delta Can Still Be Your Friend. And in it, I believe you used it as a kind of a nice teaching tool to talk about how you adjusted, I believe it was a put spread out there in SPY. In fact, it was a put butterfly actually out there in SPY, which is even more interesting. So, sir, take it away, sir. The floor is yours. Regale us with what happened there, why it was such an interesting thing for you, and why you thought it could be a useful teaching tool for your listeners, or I should say your students and our listeners.
Yeah, well, we can use Delta with any type of spread. And I guess I used a butterfly in the article or something like that. And the idea can be kind of something like this. If one really, really common technique with butterflies is legging into them and trying to get what I like to call a free butterfly, and so one way we can use Delta in order to do that is if I put on the put credit spread, and I'm kind of assuming a iron butterfly for this example. But
my favorite kind of butterfly, sir.
Yes.
Now you got me perking up again, listening again, which is good.
You're cranking In-A-Gadda DaVita in the background.
You can't hear it, but I am rocking out over here in the studio.
So, maybe I put on a put credit spread and I want to leg into the iron butterfly. Well, all right, I've got to think about it. Maybe I put it on for, whatever, a 50-cent credit, and it's $1 wide spread or something. So in order for me to put it on for free, I've got to take in another $1. I'm kind of making up numbers a little, or another 50 cents rather. It's kind of making up numbers here, but whatever. So I need to think, well, okay, I know I need the stock to go up. How far do I need the stock to go up in order for the call credit spread side to be worth enough where I can put this spread on, and effectively have a no risk situation? Well, that's where I would use Delta, where I would look at it and I would say, okay, right now the call credit spread is worth X. If the Delta is 35, well, if it goes up $1, it's going to be worth 35 cents, more. So I can sell it for 35 cents more than whatever it's worth now. So totally simple tool, totally, simple, straightforward technique, and, that'll work.
It's funny you mentioned it. You mentioned it here in your newsletter. I totally agree with this. I think you said here, what many options traders neglect when it comes to directional butterflies is the possibility of profiting from Delta. When Delta and butterfly is configured out of the money, which a lot of them are, quite frankly, for cost and a lot of other reasons, there will generally be a Delta greater or less than zero. People don't think of it, particularly the way you're thinking of it now, an iron butterfly, which is a little bit different than your traditional butterfly. Maybe we should walk people through that a little bit quickly too, since this is a kind of basic review segment. Maybe I'll have you walk them through iron butterfly in a second as well. But in general, this is something, we talk about butterflies, we talk about them from a volatility perspective, we talk about time decay, we talk about a lot of other reasons that people tend to put on flies. We don't ever talk about the often latent delta that those positions have, which means there is going to be a directional bias into that position at the end of the day, which I think was another reason why I thought your newsletter kind of stuck out to me. So really quickly, do our listeners a favor, Dan, do a quick overview of maybe an iron fly, how it contrasts to a traditional fly that they may be familiar with, and then why these things tend to have a little bit of a delta/directional bias when we put them on out of the money, which is where most people tend to put them on.
Yeah. So a traditional butterfly is when I buy, and I'll just do it. I'll do the traditional butterfly from the call side. I buy a call, I sell 2 calls with a higher strike, and then I buy 1 call with a yet higher strike. And ideally, those 3 different strike prices are equidistant. I can do them if they're different distances, but that's a little bit of a different animal. So, the whole idea is basically we can break that butterfly down into two things. We can break it down into a call debit spread, right? Because I'm buying one call and then selling. I'm actually selling two, but let's just think about one of those calls that I'm selling. Buying one call, selling another call with a higher strike, there's a call debit spread. But then I'm selling yet one more call at that same strike and buying one at a higher strike, so there's a call credit spread. So, you think about both of those trades delta-wise. And actually, like this is another great reason for delta, like from my perspective, when I'm working with teaching retail traders, is that it just makes it so easy to understand positions when you understand the delta nature of it. So a call debit spread has a positive delta. I want the stock to go up, and I've got that as part of the butterfly. And then a call credit spread has a negative delta, and I want the stock to go down. And I've got that as part of the call butterfly also. So where's the sweet spot? Well, it's right in the middle. It's right at that shared strike because, I got one spread wanting it to go up, one spread wanting it to go down. They meet in the middle. Boom, that's your best case scenario. So now it's kind of interesting. The iron butterfly actually has the exact same risk reward, although it might not seem that way at first. All we're doing with the iron butterfly is replacing the call debit spread with a put credit spread. So let's kind of put some numbers on it. This is online radio, so it's a little bit of a visualization exercise. Say the butterfly we're talking about is buying the 50 calls, selling 255 calls, buying 160 call. I could do the iron butterfly version of that by buying a 50 put and selling a 55 put, and then selling a 55 call, buying a 60 call. Now, at first on the surface, it's like, oh, well, wait, half of this is puts now. It's totally different. It's not. Another thing that on the surface looks different is that with the traditional butterfly, it's a debit. I pay money for it. And when I was referencing before, owning a butterfly for free, I was actually talking about it from the actual traditional butterfly perspective. But when I put on an iron butterfly, it's actually for a credit. So, seemingly this is like, it's a whole different thing, but it's not. It's actually the same. And here's why. And delta kind of relates to the rationale here, because synthetically speaking, a call debit spread is identical to a put credit spread from a risk reward standpoint, which includes the delta of it. All right. So we end up with exactly the same thing. Just like with the call debit spread, it's positive delta. I need, just intuitively, I want the stock to go up when I have a call debit spread. I also intuitively want the stock to go up when I have a put credit spread. And in fact, if the strikes and the expiration dates are the same, the delta is going to be just about exactly the same as well.
Good old iron flies versus iron condors. I once had someone tell me on one of our shows that iron flies versus regular flies. Even though iron condors, that's what I was thinking of when you were talking, because I had someone on my network very famously or infamously say once that the iron condor is an iron butterfly for cowards, and I've always liked that saying. Feel free to use that in your newsletter one of these days, because I've always been an iron fly guy myself. I figure if you go big or go home. If you want to do it, go do it. Get a little closer to the fire, and as long as you have the risk mitigating wings on, you're all set there. That's a conversation for another day. But there we go, a little basic. You got to get an extra bang for your buck here on the show, listeners. Start off talking about delta. We ended up mixing in a little bit of iron fly versus traditional butterfly for you guys. And if you like more of that, of course, we have check out our archives on the site or in iTunes or via the app, and you can find all of our Spreads with Wings episodes where we really get into a lot of those concepts and a lot more detail. Again, this stuff is evergreen, never really changes, so the archives, check them out. I know you guys love them. Check them out over there as well. So again, kind of quick overview. Delta, pretty much you're at the money, going to be 50. In the money is going to be plus 50, so 50 to 100. Out of the money is going to be essentially minus 50, so somewhere between 50 and 0. Use that as your kind of frame of reference. And again, delta is the directional impact of the movement of the underlying. So delta 50 underlying moves a buck, options price changes by 50. And it's a good point of entry for a lot of you retail folks out there, because it's a way you already are taught to think this way and taught to think this way when you're trading, which is with stocks, which is of course think from a directional perspective. It's a good starting point. I would encourage you though, once you start learning about the Greeks, also learn about the others and see how they impact delta, because a lot of people make the mistake of coming into the options world and they're just myopically focused on delta, and they want to buy a call because they're bullish and underlying. They want to buy a put because they're bearish, and everything they do has some sort of directional bias or some sort of delta focus to it, and they're almost oblivious or ignorant of the impact of Vega on their trade or the impact of time decay or gamma on their trade, and these things obviously are extremely important. So start with delta. Let it be your point of entry to the options world, but there's a whole big pool out there, and you can progress a little bit further. You don't have to dive into the deep end right away. Start in the kiddie pool with delta, and then move your way through. And then by the time you listen to a few of these shows, gotten into the archives, done some other stuff, maybe talk to Dan and his team over there at Market Taker Mentoring, you'll be ready for some of the deeper stuff that we get to on this network, and indeed sometimes on this program as well. Speaking of getting to stuff, Dan, I know a lot of people are waiting for us to get to their questions. So let's do it. We got a whole backlog to work through. Let's get to it. Some of your questions. It's time for the mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, everybody. Welcome to the mail call. This is indeed the portion of the program where you guys take the reins. The inmates run the asylum. Also, that's when I let Dan take over the show as well. And we talk about some of your questions, whatever you guys have on your mind from an options perspective. Hit us up over there on Twitter at Options, on StockTwits at Options as well. Facebook, we're Options Insider, or the old-fashioned way, info@theoptionsinsider.com, or via our website feedback form, which is also easily available there via the website, obviously, at theoptionsinsider.com, or hit up Dan, and he'll probably forward it to us or maybe answer it yourself or himself. So a lot of ways for you guys to hit us up. If you're streaming live, of course, you can always ask via the chat room as well. All right, let's kick things off really quickly. A timely one to start things off. We asked our listeners yesterday, Dan, because we are recording this, listeners, on Tuesday, May 2nd. So we're going into Apple earnings in a few hours. So we like to ask our listeners how they like to approach these. Typically, when we put this question together yesterday, Apple was right around 146.5. That straddle, that weekly straddle, at the money straddle is pricing in right around $5, so right around 3.5%. The weekly 155 call, so out of the money call, is about 27 cents. The 138 put, also about 27 cents. So we asked you guys, given all that data, what would you rather do? Would you rather buy the straddle or the aforementioned iron fly? We gave you that choice as well because we did give you the wings for pricing. Or we said, would you rather sell the straddle / iron fly? Or would you rather buy the call or buy the put? Mr. Passarelli, if you have a vote, you're welcome to make it, as well as what do you think our audience ended up choosing?
Well, let's see here. I'll go with what the audience ended up choosing. I would say sell the iron fly.
Interesting. I kind of thought premium selling would be a little bit more popular. It actually was our number 2. But then again, Apple vol levels, as we pointed out in the question, aren't, shall we say, in the stratosphere right now. So the juice you get for that is not what it once was. Actually, number 1 with a bullet, Mr. P. It was over 50%. It came down a little bit today as the poll closed up. 44% saying they wanted to buy that call. Does that remind you of anything? Does that remind you of kind of the heydays of Apple zealotry back in the day a little bit?
Yeah, you know what? I'll tell you what. When everybody's bullish, it's time to be bearish.
There is certainly some of that. The skew is starting to get back to those, shall we say, lofty levels back in the days when it was threatening 700 and everyone and their mother had to own calls ahead of earnings. We did see some interesting setups that, of course, made for very, very nice times to leg into vertical call spreads and things like that out in Apple, and ratios for the daring. So it's an interesting time. Maybe, I don't know if we're quite there yet, but we're starting to flirt with those levels, Mr. P. I don't know, your students, are they all have Apple on the brain again, or is this kind of just a passing thing with our audience here?
I think that people are still kind of in the habit a little bit of focusing on Apple, but I think it's a little less out of favor than it was. I mean, there was a time, and I think maybe you were referencing this, Mark, but there was a long stretch of time where Apple was one of the only stocks where there was actually a skew to the call side. Like, the higher the strike calls, the higher the implied volatility, which is basically the opposite of almost every stock or ETF there is out there, but people just loved buying those calls and they bid it up. And I mean, basically they created, not really what you would call a volatility arbitrage opportunity, though it's not technically arbitrage, but it is, a fantastic volatility opportunity for those who, were in the know and had the wherewithal to trade it.
Yeah, we can't really poo-poo those kind of things. People can distort things all they want. Distortions are great, listeners, but even if you don't agree with them, it gives you a great opportunity to take advantage of those distortions. So why would you be the 8 millionth person to come in and load up on some out-of-the-money calls in Apple when those people have generously bid those things up for you? So you can instead buy, admittedly, a little bit more expensive somewhere on at-the-money call, maybe in the money if you want to go that way, and then turn and leg into a vertical spread by selling that out-of-the-money call that people have so generously bid up for you. You can leg into those spreads for much more attractive levels than you probably could normally. And for a long time, that went away in Apple, but it's starting to come back again, which is interesting. Use that for what you will. If you want to trade in some verticals, you can. Of course, if you want to use that, maybe like Dan said, a bit of a contrarian indicator, go for it. Maybe this is the beginning of the downslide for Apple. Who knows? But that said, certainly the distortions are there, and you can take advantage of them if you so choose. All right, Dan, we got a backlog here to get to. Some of these people have been waiting for a long time for us to answer this question. Let's start off with this guy, Josh Shealy. He wrote this. This one probably came in a few months ago, so I'm not sure where the VIX was when he was writing it, but we'll answer him nonetheless because it's appropriate to our topic about Delta. He says, "Thanks so much for all you guys do. You're welcome. Sorry we haven't been doing it more lately. We'll get back to you. We'll get more out there for you guys soon." He goes on to write, "Sorry if this is a novice question. I know that Delta is not literally the percentage chance of expiring in the money." Again, covered that earlier, but more so the rate of change for a $1 movement in the underlying. I noticed today, looking at VIX calls, that the strike closest to a 50 delta was the 20 strike, which was a long way from at the money. Now, I usually associate near 50 delta with being near at the money. Is this just a nuance of VIX, or am I missing something bigger? And again, this came in a while ago to the backlog for this show. Sometimes we try to answer these on other programs, so you don't have to wait as long. But we wanted to keep this one also for this one because the people read in for this one. And this is kind of an interesting thing because VIX is a little bit different beast, has kind of a little bit different rules of engagement. When you look at Apple, and Apple's trading somewhere around 150 right now, the 150 strike is going to be your at-the-money strike. It's going to be the same pretty much across the board. So when you look at those strikes, somewhere around that level is going to be where you're going to see your 50 delta. And it sounds like you understand that from your question. But VIX, a little bit different rules of engagement. It sounds like you here are maybe conflating a little bit the VIX cash, which is what is widely disseminated, that kind of essentially, I won't say meaningless, but outside of context, it certainly has less meaning, index that is disseminated everywhere on CNBC and the local paper probably. It's one of the most widely distributed market gauges out there, often called the fear gauge. And that number, I'm not sure, I think when you wrote this in, that number, the VIX cash was somewhere in the mid-teens, probably around close to 14 or 15. So you were obviously confused because why would the options that were around a 50 delta, which is traditionally at the money, be around the 20 strike? Well, I'll look when you send this message in, but just from your question, I'm going to interpret that you also have to price the futures. VIX options are priced off the futures. Again, different beast than your standard equity options. And the futures are going to dictate where that at the money is. So in this case, the future, I think you're saying December or maybe a little bit past that. So you're actually looking a few months out. So these futures are going to be typically a little bit richer than where the cash is. And in this case, they were a lot richer, to the tune of the futures were around that 20 level. So in that case, that's pretty much what you're looking at. You were conflating the VIX cash, which is its own beast, and I won't say is independent of the futures because obviously they all are interconnected, but you cannot price the VIX options off of where the VIX cash index is trading. You have to look at the appropriate future that for your option. And again, there's a whole string from the whole term structure, which is why the VIX options are somewhat an unwieldy beast for first-timers to options, because there's a lot to sink your teeth into and really get your head around when you're looking at those for the first time. But that sounds like what you were up to there. You're looking at the VIX cash, but the futures, which the options are priced off of, were at a different level, obviously much higher Anything to add to that? Dan, I'm sure you get this question a lot over there at MTM. People come to you, they get lured to the dark side of VIX. Maybe listen to our Volatility View show, who knows? And they want to come to you to learn about this thing, and like, how come it doesn't match up with the cash?
Yeah, I mean, as a member of the options community, I just want to thank retail VIX traders on behalf of professional VIX traders for giving them money on a regular basis. You should actually talk to your accountant to see if losing money on VIX is a tax deduction, because it's basically a charity hobby for many people. When people start trading the VIX, they think it's, hey man, I trade Apple options, I trade SPY options, the same thing, right? It's nothing like it. It's just nothing like it. And most people who come to me with questions about the VIX really don't even understand, what it is they're trading, because it's so different, and this question's a perfect example of that. Well, wait a minute. I thought the at the money was a 50 delta. This is an out of the money call. Well, it's actually not an out of the money call, because you're looking at the wrong thing. Like Mark said, you can't look at the cash. The cash VIX is not the underlying for VIX options. So, yeah, I mean, I advise people. I mean, look, options in and of themselves are, they're more complicated than futures or stocks. I advise everybody, learn first, then trade. If you're trading VIX options, really learn first and really feel like, okay, now I really get it, and then trade. Otherwise, you're just giving money to professional traders.
There you go, Dan Passerelli, thanking all of you for donating money to the pros out there. And yeah, VIX is an unwieldy beast, however you come at it. There's the futures. They have added weekly futures now. There's weekly options on that, and they all move kind of independently but related, and there's a context to all of them. It's definitely should not be your starting point when you're coming to options, because you will probably run screaming the other way and say, why did I do this? I thought it was supposed to be simple. Mark and Dan said it was simple, and you misled me. So yeah, start off with a stock and you like, that you follow religiously. Use the basic Greeks like we just talked about with Delta, and start that way. And then slowly over time you get in too deep too fast, you're not going to appreciate the experience. All right, next up, we got Brian 14. I'm not sure how to pronounce that. Either way, he actually attributes a saying to you, Dan, that I don't think I've ever heard you say. So maybe I've missed this with you. He says also calls you Options Bootcamp Dan. I like that. He says Options Bootcamp Dan is fond of saying, why trade options naked when you can spread off the risk and make the same money by doing it twice? I feel the same way about carrying a short position into expiration. Why try to carry 6 short contracts into expiration to capture the last 5 cents when you can just trade 7 contracts and do the right thing? Well, first off, Dan, do you say that? I never heard you say that before. And then what do you think about what Brian is attributing to you?
Yeah, no, you know what? I'll tell you what. I've been known to allude to that. And we've had this conversation on the show before, where I said, cash secured, selling puts outright are great as a cash secured thing in an investment account where, like, you got to park the money in stocks anyway, and basically you hope you get assigned, but if you're hoping to not get assigned, you don't want to get assigned, you're just way better off selling 2 spreads instead of 1 spread, or 6 spreads instead of 3 spreads, because you make the same amount of money and have a fraction of the risk, And I totally like what I was going to say caller. I guess we don't call him caller. What do we call him? Emailer.
Listener. They had to listen to write the email, and so I just usually call them listeners.
Listeners, yes. I love what our listeners saying about closing stuff at expiration, because at some point, a lot of times you put on a put credit spread or something, the stock goes up, and, you could buy it back at a nickel now, but you say, oh, no, I don't want to leave a nickel on the table. Even if I have to wait another 3 weeks to get that damn nickel, I'm going to wait 3 weeks and tie up all this capital and hope there's not a black swan event and I lose $4.95 trying to get this nickel, So yeah, I'm totally with our listener. Close it, take the profits off the table, and put on a spread where you can actually make more money with a better risk reward, maybe even in the same period of time.
I like that. I agree with you. I'm going to start calling you Options Bootcamp Dan. I just like that. So I'm going to go with a lot of things that Brian said here in his email. Yeah, pigs get fed, hogs get slaughtered. And if you're a hog, you wait for all those nickels to come pouring in. That's when usually bad things tend to happen. Have a nice approximate profit you want to make of the trade when you set it up. When you get to that level, close it out, move on to the next one. Because Dan's right. You're not only are you waiting for that nickel to come in, which may or may not happen, but also you got all your capital tied up. If you would not come in and reinitiate the trade at that same level now, would you sell this for a nickel? If you're going to say to yourself probably not, then you probably shouldn't have it on anymore. Take it off, go on to the next one while you're waiting for that nickel to come in, which takes a long time. Trust me. A lot of other things are going to happen. You're probably going to miss. There's an opportunity cost to that as well as the capital cost of keeping your margin tied up, as well as just the risk of all that for that last nickel. All right, we got a lot of other questions, but I wanted to get to this one. Dan, I actually moved it from one of our other shows to this one because it caused such a great debate on this program. I thought it was definitely a worthwhile one to have here as well because it just seemed to confuse a ton of people. We had a listener, I think it was on Bootcamp, Option Block, right in one day. His name was Game Day Dog. He had a great story. He says, oh man, my vertical put spread went bad. I had 3 options at 61.5. This was in Lululemon, I believe. At 61, I was long 3 options, 61.5. I sold 3 puts at 62.5. So he sold listeners a $1 put spread, a 62.5, 61.5 put spread 3 times in Lululemon back when the stock was around in the 60s somewhere. He said, when the time he wrote this question, he said, yesterday it gapped down to 50. If you've been paying attention to Lululemon, you know they've had some tough times of late. He says, he came in the next day to his trading account. And he had a bit of a surprise waiting for him. He said, I now all of a sudden have 200 shares of Lulu in my account, plus 3 put options at 61.5. So he's long 3 put options, 61.5. Those are still there. And he's only short 1 put option at 62.5. He said, I thought this was a $300 max risk spread when I put it on. Do I have to do anything? Should I sell these shares? Everything expires in 7 days. Please help. And then this kind of set off a big conversation about expiration and how assignment, how all that stuff works. A lot of people wrote in with follow-ups, like Elio says, I'm confused. How did that guy end up with only 2 of his short puts getting assigned to him? If he was short 3, shouldn't all of them have been assigned? Adjack asked, you answered a question from Game Day Dog the other day about put spread gone banned. Is this a reason not to trade spreads? If these sort of complications can pop up, I think I'd rather stick with stock. Tony Rather said, thank you. I have a follow-up listener mail. He said, how does all that go away in 7 days? I don't understand that. So we had a lot of back and forth on this, Dan, a lot of interesting questions. I thought it was definitely worth exploring here. I'm sure this is probably an issue that you've encountered with your mentees, your students over there at Market Taker as well. In a nutshell, someone comes in, sells at the time probably out of the money put spread 3 times. A nice risk mitigated. He sells it. It's a $1 put spread. He thinks his mask risk is $300 if it goes against him. He doesn't say the prices he got for it, but he got somewhere less than $1, we're going to assume, for that $1 put spread. He comes in the next morning, checks his put spread. Oh, no. Stock gap down through my strikes. And now all of a sudden I have been assigned on 2 of those 3 puts. And now all of a sudden I have this stock. And I also have these puts. And, it's important. This is going to happen. So maybe we should walk through the assignment part first because this is something that people freak out on. They think, I have a spread, nothing can change. Things can change, particularly in this kind of scenario where things gap down. Lulu is gapping down. Guess what happened? In that environment, people are scrambling to get short. So what are they going to do? They have puts that they bought, which thankfully they bought from our friend Game Day Dog. And it shows you how many people were exercising their puts because he only had 3 of them and he got hit on 2. That's a lot for such a short, small position. So obviously people are scrambling to get short. Sometimes they'll take a choice which really is disadvantageous to them to exercise an option early, short of exercising it on a call to capture a dividend is really never an advantageous thing to do. You're going to give up all that time premium on the option. But they're still doing that anyway because they need to get short. They got to get short to capture some of that downside move in Lulu. It's just gapping too hard. They can't get the stock. So that's what happened to him. He got assigned on those, and all of a sudden, 2 of his short puts went away. And now instead, remember, short put, you're giving someone else the right to sell that stock. Means you're guaranteeing to buy it. So he bought it. But he shouldn't sweat because he still has all 3 of his puts on the long puts to cover that. So effectively, his spread is still intact. It just looked scary when he came in the next morning. He saw this big stock balance, all this money tied up in stock, and it was really a terrifying thing. Dan, I'm sure you've seen this scenario happen with some of your mentees. So what do you have to say to listeners who are concerned like that? Like some of our listeners, they're confused about how the short assignment process works. Some people saying this scares them off of spreads. What do you have to say to people who are concerned about this, as well as maybe have you ever seen a similar scenario, and what did you tell your mentees?
Well, it certainly shouldn't scare you off of spreads. I mean, are you scared to drive your car? I mean, if you drive your car with your eyes closed, you're going to crash your car. And that's kind of what happened here. Like, it looks like Game Day Dog put on a spread and maybe went on a cruise, went on a drinking binge, something happened, and he didn't pay attention to his spread for some period of time, and he let it get in the money. Now, like, look, I tell every single one of my students, every single time, you have to have a plan. You have to have a plan for when to take your profits. You have to have a plan for when to take your loss. And letting a credit spread go so far in the money that the short puts are an assignment risk, I mean, that's not a good plan. Like, you should have been out of this spread probably way before then. Now, I don't know. I mean, I think this is a while back, so I don't remember if it was just one big gap one day or what, but still, even if you're not a super active trader, if you've got an option position on, it's a really great idea to at least check once a day all the underlying prices of all the positions you have on and make sure there's nothing wrong. So it's not like you have to stay in front of your computer, 8 hours a day, every single second the market's open, but you have to monitor them. Options are not buy and hold strategies. You don't put it on and 10 years later come back and say, hey, Martha, whatever happened to that put spread we sold back in, 1987? It doesn't work that way. Like, you put it on, they're trading vehicles, not investing vehicles. So, I mean, the bottom line is, if you have a credit spread that goes in the money, like, already the hairs on the back of your neck should be standing up. You should be going, oh my God, I got a hot potato. What am I going to do? I got to get out of this. This is a bad situation. Whenever short options are in the money, it's not always the case, but you should assume, hey, I could get assigned on this. Generally for puts, the rule is when there's almost no time value left, it becomes a risk for assignment. And there are special cases where, there's some deviations to that rule, but that's a pretty good rule. When something's so far in the money that there's very little time premium left, you should assume you're going to get assigned. You should assume you're going to be buying stocks, so you need to take an action.
Yeah, this one had all the interesting nuances. You had the gap down, which is, of course, one of the big risks when you're selling put spread like that, or options in general. Gap risk is always the thing that has to concern you. The assignment process, let's just clarify that really quickly. The assignment process is effectively random. It's going to be biased to people who have more larger positions. They have a bigger chunk of open interest on the strike, which is why it's weird that someone with only a 3 lot would get 2 of his 3 assigned randomly. That shows a lot of people were taking advantage of that to exercise their options. So yeah, just because you're short 3 doesn't mean you automatically get assigned on all of them. It's a random process. You can get, usually in most scenarios, you'll get none. Because your options, it just doesn't make sense to do that unless there's an aggressive movement like we saw here in Lulu. And then, of course, it does make sense. And even still, he only got 2 out of 3. So it's a random process. You never know how many you're going to get if this does happen. So first off, let's clarify that. There's no real rhyme or reason to it. And then secondly, he's stopped out. That's why he shouldn't be concerned. He is stopped out. He sold 3 put spreads. 2 of them the short puts got assigned to a 62.5. He still is long 3 puts from 61.5. So that means he has 1 put spread effectively, and then 2 extra 61.5 puts against that stock, which means he is effectively stopped out at 61.5, which is why he doesn't have to worry. No matter what happens to Lulu, he can always exercise those 2 now extra puts he has, which means he can sell his stock back at 61.5, no matter where Lulu is. That's the magic of options. That's why he has those. That's why he bought those. So that's why if this happens to you, don't panic. I think he ended up unwinding the whole thing almost instantly, which wasn't a bad do either. It still helped out. But yeah, that was a fun one and a learning scenario. I think a teaching moment for just about everyone out there. This can happen to you. Don't panic. And then write to us. We'll walk you through it. All right. So I think we got time for one more here, Dan. This is kind of these are 2 similar questions, so we lumped them together. This is like an old saw in the options business. People really, people still, you see this in pitches, late night infomercials. These emails I'm sure everybody gets saying, make $1 million tomorrow using options. And they all teams to focus around this one argument. This one comes from these two. One comes from J-Dog, and then one comes from Alan Shepard. The first one, J-Dog, says, I guess got an options pitch that said that options buyers lose money on 7 out of every 10 trades. Is that true? And then Alan Shepard had a similar question. He says, why would I ever buy an option? He says 90, when 90% of them expire worthless. This is... Like I said, this is an old saw in the options biz. It's been bandied about for a while. The actual percentage is a hotly contested thing. People who are premium sellers will say one thing, like 90%. OCC will say something else entirely. It's a big, hotly contested issue. I'm sure you've seen this before, Dan. Where do you fall on this contentious issue, and what do you have to say to J-Dog and Mr. Shepard, who seem to be getting lured to the dark side?
Well, yeah, I mean, there's some misconceptions and poor ways of looking at this. As I understand it, the CME says something to the effect that 70% of options expire worthless. But that's not necessarily true, because most of them are traded out of and bought back. The ones that are left over may expire worthless, but most of them are closed by, smart traders. Very few people hold trades all the way until expiration. So the Options Clearing Corporation says something completely different. They say something to the effect of 10% are exercised or assigned, 30% expire worthless, and the balance 60% are actually closed prior to expiration by, responsible risk managing traders. So the question is, why would you ever buy an option? Well, to make money. That's why you would buy an option. It's a different game, and there's a different risk reward paradigm that is balanced off by the likelihood of winning. If you have a strategy, like let's just say you had a strategy that loses 70% of the time, okay? If on the surface it sounds like a pretty bad strategy, I don't really want to do that, right? But let's say every time you lose $1. Every time you win, you make, $100. Well, okay, that changes everything. Yes, I want to do the strategy that loses 70% of the time, and I want to do it 1 million times, right? So, it's a little bit of a different way to think about things. Like a lot of people just like to think of, people who come from the stock trading or futures trading world, they just think about their percentage of winners. But it's very, very different in options, because it's not just your percentage of winners, it's your percentage of winners balanced out by how much you make and lose on each trade, by your risk reward structure of the trade. So although, this ends up we can do a 5-hour show based on just this, because then there's the observation that options are typically overpriced, which does give some sort of edge to option sellers, but not across the board either, which gives rise to long discussions on volatility analysis and so on.
When in doubt, palms out, sir. I'm sure you never heard that one, right? So,
yeah, exactly right. Well, yeah, I haven't heard that for a long time.
There you go. Everything old is new again on the Options Bootcamp program. But you're right. This is an interesting conversation. Probably could spend maybe we should do a whole show on this down the road a little, because there are so many things that are conflated in that statement. You're right. First off, the notion that people typically don't hold their options to expiration. That's not a normal use case for options, so that perspective changes things. And on top of it, it depends on the product you're looking at and what's going on in that product, what exact percentage are going to expire in that realm. So people who just take this one stat and just throw it out there apropos of nothing else. Remember, in the options world, you have to have context to everything you're talking about. And just these numbers alone, these percentages alone, without the context. Look at the example Dan just gave you. There are a lot of examples like that out there that on the surface sound completely one way. And then when you think about the context of them, they actually sound completely different. So it's something definitely to keep in mind here. Let's see. I kind of lied, Dan. Maybe I think we have time. Let's see if we can do one more. This is another combo one. So put your pants on here for one more combo question. Let's see. These similar questions come from Anderson Investing and from Shark Cake. I like the handles today. Anderson Investing says he's new to options. I use TD Ameritrade, but I currently don't like it for options. I was looking at Charles Schwab. Any recommendations for an options newbie? And then Shark Cake says, I've been approved to trade my options by my brokerage, but yet to execute my first trade. What trade do you recommend? So maybe we'll start off with the Anderson question first, Dan, which is kind of interesting because he asks, what is your recommendation for an options newbie? Actually, Thinkorswim Toss would be one of the ones I would have recommended for him because they actually have a lot of content from an educational perspective. You can hang out in their chat room all day. That's the kind of thing newbies tend to like. They like to have someone to help them hold their hand, and they're in the hand holding business. They will do that with you. Also, obviously, our buddies over there at Trade King do a lot of educational content, which is something else that a lot of retail, particularly basic retail, like. So if you want to get that, that's a good place for it. Even though our gold guys at Options House, I would say stay clear of IB. They're not for the basic retail trader at all. So stay clear of them unless you're pretty sophisticated. But I don't know, Dan, you must get this question a lot. A, what do you recommend for an options newbie? Then if you want to go down to the second question of what type of trade or what strategy you recommend, you can go for that as well.
Yeah, as far as which platforms. So, this kind of goes along with what I was saying before that, options are very different than equities. You need a whole different set of tools. They're a niche within the trading market and a very growing niche at that. So, maybe the regular TD Ameritrade that's geared towards, old-fashioned stock investors is not great for option trading. But the Thinkorswim platform, which is part of TD Ameritrade, that is geared towards option traders, and it's good. Charles Schwab, their old platform that's geared towards old-fashioned stock investors, maybe not great for option traders, but Options Express is their options version of it. And the same thing, E-Trade, if traditionally hasn't been very good for option traders, but now that they bought Options House, now they have a really good platform. So, look for options-centric platforms, and most of the major online brokers have, subsets that are really good for options.
Yeah, that's a good point about the the Schwab. Definitely, I would say if you're going to do Schwab, definitely go to the OX platform because it's got all the functionality there that you won't get on the Schwab. The thing about OX, there are on the pricier side. So if you're commission sensitive, watch out for that. But yeah, platform wise, OX, and yeah, I didn't think about that with TD. That you're right. It could be using some legacy TD platform, which to me would be silly. If you're an options guy, definitely use the TOT. That's what it's designed for. So if you're not using that, go for it. Really quickly, if you have any recommendations, if someone comes to you first timer, and I know it's a bit of a nuanced question. We don't have much time for it. If you want to hold it off for next show, we can do that too, Dan. Your call. Question from Shark Cake.
Pick a winner. The thing is you like I said before, you start first, you learn, then you trade, and when you start trading, don't start with the gamma trading 5-strike ratioed spread during a full moon. Don't start with some crazy spread. Start with more basic positions, but the more complex positions tend to be better, tend to give you better risk reward, better chance of success. That's why people trade the more complex stuff, not just because they're fun, so start with the basic ones, but then kind of quickly grasp them as fast as possible and work your way up to, better trades, to spreads.
Well said, sir. We'll have to leave it there. Thanks to everybody who sent in questions. Thanks to everybody who tuned in after the fact as well as live. We love all you guys out there. And sorry we've been gone for so long. We've been busy. Dan and I have been busy doing a bunch of other things. Thankfully, our network has still been cranking out a lot of good content. So if you needed your options content fix, we have you covered. But now Bootcamp's back. So stay tuned for more good stuff like this. And before we go, Mr. P, tell our folks out there, what are you working on? What can they come over to MTM and check out that may interest them these days?
Well, we are launching a brand new chat room. As a matter of fact, I was just working on an email announcement for that right before our call. So that is really exciting. That's big news. This is going to be probably the best chat room out there for option traders. And that should be launched, within I'm thinking 24 hours, but we'll see.
And where should they go to check that out, sir?
Well, actually, I'll tell you what, if you're on our email list, you can just go to markettaker.com and just go to the Contact Us tab and just type in, yes, I'm interested in the chat room, and we will get you hooked up, my friend.
There you go. Hit them up. And if you're not on that email list, head on over to Market Taker Mentoring or just search for it in your browser and you'll see all that good stuff. Who knows, maybe next time we do the show, Dan, we'll have some good chatting to do over there through the MTM chat room. So check it out over there. And on behalf of Dan and indeed myself, I want to thank all of you out there in the listening audience for downloading, streaming, subscribing, sending in questions, joining us live, all the things you guys do all the time. We love you all. And we'll see you next time for more Options Bootcamp.
Options Bootcamp is produced by the Options Insider, Inc. All rights reserved.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.